This is Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with an asset owner from New York Life Investments. Lauren Goodwin, CFA, is an economist and a director of portfolio strategy with New York Life Investments' multi-asset solution team, which has $11 billion in assets under management. Prior, she was an international economist at Wells Fargo and managed the global economics practice at Frontier Strategy Group. She has also held positions at JP Morgan Chase and the OECD. Lauren got her master's at Johns Hopkins and her undergrad at USC. So Lauren, thank you very much for being here. We're at a weird time right now. We're recording this here in the middle part of March. And it's tempting right now for a lot of investors to focus too much attention, in my opinion, on short-term risks. So I'm wondering what risks you all are recommending long-term investors focus on, and how do you reach them with all the noise in the market right now?
Well, Rob, it's a really interesting question. And first of all, thanks so much for having me. It's great to be talking in these, as you're saying, very interesting times. Typically, during a big market sell-off, and to say that we're in the middle of a big market sell-off would be an understatement, I think. But typically, in times of market volatility, the main thing that we are working with our clients on, anywhere from the retail space to the institutional space, is sticking to your strategic plan, understanding your risk preference, your risk tolerance, some of these classic CFA topics, and making sure that you're investing accordingly. Right now, I think, I hope that you're right when it comes to the idea that this risk is being overblown by the markets. But I think that we're about 3 to 4 weeks away from really understanding the extent of the potential market damage that this virus and its economic impacts could have. And we can talk about that more if you want. But because we are, there's so much uncertainty about whether this will get a little bit worse and then get better or get a lot worse, we're holding off actually on making big strategic moves in our portfolios and playing pretty tactically for the short term.
Okay, well, that is interesting. So with the uncertainties around it, could you walk me through the math on how you all believe that there's a 3 to 4 week range before we get to some more clarity?
Sure. That 3 to 4 week range all comes down to what I think is the major risk for the economy, which is the credit markets. So there are some unknown unknowns that we have with respect to demand destruction, people working from home, being worried about going to restaurants, not traveling. These are things that we know will impact the economy. But the way that they impact the economy is through businesses, and there are secondary and tertiary impacts there. There are companies that aren't bringing in revenues. There are people that maybe aren't being brought in for their shift at work, and those revenues that companies won't be getting are problematic, of course, but particularly so because profit margins for companies have been decelerating for the last 5 years already. And so companies didn't have a whole lot of cushion against a shock like the one we're experiencing. And so 3 to 4 weeks is around the time when we think that credit markets, including private credit markets, will start to experience a real oh no moment if we're still experiencing increasing case volume. And what I mean by that is because these companies, in the economy don't have a lot of buffer, their profit margins aren't super strong. And because deal flow has mostly stopped as everyone's waiting to see sort of what will happen in the market, another month or so and those lending lines could dry up. We're already starting to see it happen. And that's when you start to see a real struggle through the economy. Now, there are policies that could help intervene, but that's I think, the real risk of getting worse from where we already are.
Right. Okay. And you mentioned the private markets, and that is something I'm keenly interested in because of the diversification that they bring to investors. And some insulation they have. So what's your view of the private markets right now?
So before this coronavirus threat came to light, there were already some concerns about private capital markets, not blanket concerns, but just concerns that we were seeing across asset classes that you needed to be in higher quality assets lending, whether through private credit or private equity, in companies that have a clear line of sight on value creation. Just being careful because valuations were stretched. What we're seeing now is that those stretched valuations and that flight to quality are being exacerbated by the current crisis. And it makes sense, right? If you are lending into this space in a very uncertain time, you're only going to be lending to the companies that you feel pretty certain are going to be able to pay you back or be able to add value over the long term. And so that just makes it a little bit harder for some of those second tier companies to access financing. And so we are seeing issuance in deal flow in private capital markets starting to slow. People can't travel, they can't do their due diligence. So it doesn't mean that those deals won't get done, but they won't get done right now. And it's from those that line of sight on the ground that we're hearing that, things are okay for another 3 or 4 weeks, at which point people will start to worry a little bit more considerably.
That's interesting. I just want to accentuate one thing you just said, was that the prohibitions on traveling by a lot of investment management companies could really hurt this, because if it's a critical portion in the due diligence process. That's fascinating. But let me shift a little bit to the macroeconomic part of the market. And I just want to check in with you, because a few months ago when you were here speaking at CFA New York, yours was one of the early voices talking about the issues in the service sector. So could you give us an update on what you're seeing in that now?
Sure. So the main, that voice of, I'll say reason now that we're a couple months out, that voice of reason from January was that it was about profit margins and how we'd already seen some stress in the manufacturing sector because of trade wars, because of China's slowdown, because of just being late cycle generally. And what tends to turn next is the services sector. And that's where we were watching that profit margin number really closely. Now, what I said at the time was, as these profit margins have decelerated, companies have less buffer against risk. Well, now we're seeing the risk.
Right.
And it's a pretty nasty one, right? You have not only the economic impact of slowing activity, but you have people being afraid, and that can really exacerbate a negative shock in the way that we're seeing. And so essentially, while we're not seeing that service sector shock in the economic data yet, we are seeing it in fast-moving business surveys. We're seeing it with our eyes. There is a lag with the data. And so I am strongly concerned that this impact to businesses' top line, where they won't have a lot of flexibility on their labor costs or their rents or some of their input costs, means that those profit margins will get squeezed or even disappear. And so I would expect that we'll have stress in the services sector. I would expect that we'll see an increase in defaults from companies that were already sort of right on the line. Right. And that's, of course, that contributes to weakening demand moving forward.
Right. So that weakening demand can sometime sort of reach down to the consumer, which, of course, in the U.S. market is the linchpin, and can be an indicator of later risks. What are you and your team watching in terms of the health of the consumer?
I think it's important first to say that economic data generally is going to be a completely unreliable guide to investment strategy in the coming months. I think market readers are going to struggle to assess how much of a slowdown in data is due to the virus's impact, which should be transitory, even if it is very severe, versus underlying weakness, which may not be transitory and could still be severe. So some of the indicators that I would have answered this question with a couple months ago, things like consumer sentiment, consumer spending, new unemployment claims, we're still watching those. I think they're very important, but they're not going to move fast enough to keep up with what is a situation that's evolving daily, if not even more quickly than that. And so what we're watching, what we're expecting now is for things to get worse and for consumption to be hit, and for the U.S. economy to struggle, at least in the short term. So what I'm really looking at is indications or clues that would help that not be true. So that would be things like a coordinated and targeted government response that helps to keep not only households or the consumer, but also small businesses afloat during this cash crunch. So things like paid sick leave, keeping people healthy, keeping people, able to buy that coffee in their communities or pay their gas bill. Those are the types of things that I think are really important for how resilient the U.S. economy will be, or how much it will hurt. We're also very closely monitoring the geographic spread and case volumes of the virus. I think that we're at a tipping point, right about now, and of course we're recording this mid-March, where it'll take a pretty substantial improvement in the spread of the virus to make people feel more certain, to make companies bring their people back into work, away from work from home, et cetera. It let people travel again. Right. And so that government policy response, the virus's decline, these are essentially the types of indicators that we'd watch in any sort of exogenous geopolitical shock, where economic data doesn't give you the best indication of what's happening on the ground.
Okay, that is also interesting. Perhaps we should leave it there. I will, in the show notes from this, link to a couple of your blog posts on your website. I thought some of them were really interesting. And thank you all for listening into Compound Insights by CFA Society New York. You can find other episodes on the podcast app of your choice and on our website, cfany.org.